Look at your 401k balance right now. It looks massive, doesn't it? Now try taking a single dollar out to use today. Suddenly, you realize that money isn't really yours anymore. You stare at your impressive retirement balance, but your chest tightens when the reality hits. You cannot touch a single dime of it for another 20 years without triggering brutal financial penalties. The traditional financial industry has successfully convinced you to lock up your hard-earned liquidity, entirely so Wall Street can quietly profit while you carry absolutely all of the systemic risk. Here is the diagnostic reality. You are a high-income corporate professional. You are highly disciplined. You are executing exactly what every certified financial planner, every HR benefits deck, and every mainstream money publication has aggressively told you to do. Max your 401k. Defer, defer, defer. And yet, your net worth looks incredibly impressive on paper, but your actual deployable capital, the real money you could use to buy a cash-flowing asset, fund a business acquisition, or structurally buy back your personal time right now, is essentially zero. By the end of this deep breakdown, I am going to expose the exact institutional mechanism the traditional financial planning industry uses to manufacture the total illusion of wealth while systematically starving your present-day liquidity. And I will show you the precise asset structuring approach that high-net-worth executives are deploying right now in 2026 to generate compounding wealth and maintain total capital access simultaneously, with absolutely no penalties and no IRS handcuffs holding them back. Let's call this exactly what it actually is: the Deferred Liquidity Illusion. You have $900,000 sitting in a 401k. That number feels like solid proof. Proof that you have won the game. Proof that the decades of discipline are working. But that $900,000 isn't actually $900,000. Not in any real, functional sense. Touch it before age 59 and a half and the IRS immediately extracts a massive 10% early withdrawal penalty directly on top of your standard ordinary income tax rate. For a high earner sitting in the 37% federal bracket, which in 2026 begins at $626,350 in taxable income for single filers, that combined extraction rate rapidly approaches 47%. Nearly half of your wealth. Gone in an instant. So your $900,000 retirement account? In a sudden financial emergency, a rare business opportunity, or a major life pivot. It functions much closer to $477,000 of real, accessible wealth. You essentially built a giant vault and handed the only key over to an institution that benefits directly from keeping you locked out of your own money. This is not accidental. It is architecturally intentional by the corporate system. The mechanism has a specific name. I call it the Liquidity Siphon. Here is exactly how it operates at the structural baseline level. The traditional financial industry, including advisors, fund managers, and institutional custodians, earns heavy fees based purely on assets under management. The longer your capital remains securely locked inside their managed accounts, the longer they get to extract basis points directly from your balance. In 2026, the average 401k carries an all-in expense ratio floating between 0.5% and 1.2% annually across various administrative and fund-level fees. On a $900,000 balance, that is somewhere between $4,500 and $10,800 taken from you per year. Every single year. Regardless of market performance. Regardless of your changing life circumstances. Regardless of whether a massive $150,000 real estate opportunity just crossed your desk that would have easily returned 22% annualized. The system is simply not designed for your true financial freedom. It is explicitly designed for continuous institutional fee extraction, and the strict IRS penalty structure is the ultimate enforcement mechanism that keeps you compliant and trapped. Now here is where the math becomes genuinely brutal for the corporate executive specifically. The standard 401k contribution limit in 2026 sits at $23,500 for normal employee contributions, with an additional catch-up allowance of $7,500 for those age 50 years old and above. A highly compensated executive earning $500,000 annually who maxes his pre-tax 401k is deferring $23,500. roughly 4.7% of his total gross income, directly into a completely illiquid, heavily penalty-gated corporate structure. Meanwhile, his marginal tax savings on that specific contribution at the 37% federal bracket is approximately $8,695. He saves exactly $8,695 in taxes today, but entirely in exchange for surrendering his full capital control over that $23,500 for potentially 2 or more long decades. That is not strategic optimization. That is a terrible trade that only benefits the financial institution holding the asset. Now, compound this massive flaw across a 15-year career of disciplined account maxing. An executive who consistently contributes $23,500 annually for 15 years, assuming a standard 7% average annual market growth rate, accumulates approximately $594,000 inside his 401k. On paper, it looks highly impressive. But every single dollar of that trapped capital is strictly subject to ordinary income tax upon withdrawal in retirement, meaning the deferred tax liability actively follows the balance like a dark shadow. If he withdraws that $594,000 in retirement at a blended effective rate of 28%, his actual after-tax realized wealth is much closer to $427,680. He willingly locked up his most highly productive capital during his absolute highest leverage earning years, the crucial years when he actually had the professional network, the sharp expertise, and the necessary risk tolerance to deploy it into aggressive wealth-multiplying vehicles, only to ultimately recover just $427,680 in a later decade, when his natural risk appetite and physical energy have structurally declined. The heavily promoted deferred tax benefit was never the generous gift they sold you. It was always the bait. Here is the major institutional-grade reframe that completely changes your entire capital allocation philosophy moving forward. The smart executives who are structurally way ahead of the curve, the ones who are not just wealthy on paper, but highly liquid and compounding their money simultaneously, have completely stopped treating tax deferral as their primary financial optimization objective. Instead, they are actively operating what sophisticated advisors call a split-stack capital architecture. Now, I know that sounds like a very complicated piece of Wall Street jargon, but the concept is actually incredibly straightforward and relatable to your everyday cash flow. It simply means splitting your money into 2 distinct buckets, one purely to capture free money, and one for actual real-life leverage. The core concept is simple, but the execution requires strict discipline. You do not completely abandon tax-advantaged accounts entirely. You just fund them to the exact minimum threshold that captures any free employer match, and not a single dollar beyond it. That successfully captured match is an immediate 50% to 100% guaranteed return on your contributed capital, which absolutely no other vehicle on the market can compete with. Every single dollar beyond that specific match contribution then gets strategically redirected into a parallel, highly liquid, after-tax investment architecture, such as direct index funds held inside taxable brokerage accounts, cash-flowing real estate held securely inside an LLC, or a properly structured cash value life insurance policy utilizing a specialized high early cash value design. These specific vehicles do not magically generate the exact same upfront tax deduction, but they do something far more important. They preserve your absolute most irreplaceable asset, total capital optionality. Because here is the raw reality the traditional financial planning industry will never, ever put in their glossy client presentation decks. A 45-year-old corporate executive with $300,000 in fully liquid, immediately deployable capital and $600,000 in retirement accounts structurally possesses significantly more net life leverage than a 45-year-old with $900,000 trapped entirely in deferred accounts. The liquid executive can actually act. He can acquire new businesses. He can pivot his career completely. He is never waiting for the IRS to generously grant him permission to finally access his own hard-earned wealth. Time-locked capital is not real wealth. It is merely a scheduled payout with heavy institutional strings firmly attached to it. The single most important shift you can make today is this: begin actively measuring your true financial health not by looking at your total account balances, but by calculating your liquid asset ratio, the exact percentage of your total net worth that you can freely deploy within 90 days without facing a single penalty, without triggering massive tax events, and without dealing with any institutional gatekeeping. Foremost highly disciplined high earners strictly following conventional financial advice. That crucial ratio is shockingly close to zero. And the brutal truth is, the liquidity siphon does not operate in total isolation, because the exact same capital being slowly bled into locked retirement accounts is the identical capital being quietly drained by a completely different, highly systemic pressure working against you at the household level. Click the video on your screen right now, and let's pull back the very next layer to completely dissect how the 4 elite parenting costs are mathematically dismantling the private balance sheets of some of the smartest men currently working in corporate America.